we've got for lead per unit. Ratio estimation. If you came out something a little different than this, it could be because of rounding, either my rounding or your rounding, but it should be pretty close to this. If it's not exact, I wouldn't put it. And then the hard one is the difference estimation, and that is that everything on their books is understated by 174, so we're going to multiply that times 1,000 accounts payable, saying everything's off by the same amount, and projecting this. Okay, all right. Any questions on that? All right, let's here. Okay. I think let's go ahead and jump into the everyone to handout. We have a Medtrans page. Okay. All right. So I think we were on page 2. Yeah, you can be very far in this thing. Types of audits. Okay, types of audits. The first one is financial audit. This is sometimes called examination. And those are performed by CPA firms. And I think I told you guys this. CPA firms are the only ones. If you get your license, that's what they license you to do. This is what your CPA license allows you to do with a financial audit. And that's what this class is mostly based on. This is what the CPA exam is based on. This is what this class is going to be usually looking at. Second type of audit is an operational audit. And this audit is you're looking for effectiveness, efficiency. This is for future improvements. Let's stop here for a second. And kind of contrast these two. Oops. Okay, so there is a difference between these two types of audits. So financial audit, they'll come in and they'll see if your financial statements are not misleading, if they are fairly presented. Operational audits, you're looking to improve things. You're looking at the operations effective, are they efficient? So this is one of the strange things about auditing. That how do you help those help your client? If you're doing a financial audit, you are not trying to make them more profitable. It's like I'm tipping over here. You're not trying to improve their business. So if we're doing a financial audit of IBM, we're not trying to make IBM better. Simply seeing if their financial statements are fairly presented. And that's it. We are not trying to help our client in their operations. Operational audit is a different type of audit. An operational audit is an audit where you are trying to help. You say, okay, how can we do this better? How can we make your website better? How can we make your customer base easier to contact and whatever. So operational audits are done, and I've done, but they are way different than financial audits. Financial audits, you have to be independent. Operational audits, you don't have to. You're trying to help them, you're trying to improve their business. So big difference between operational audits and financial audits. Financial audits are only looking at financial reporting. So only looking at financial reporting. And this is what the CPA exam is aimed at, because these are the ones you get your license for. You get your CPA license. Okay, so operational audits. That is to see if they comply. Example of this would be tax audits. There could be other ones too. So, Well, I'll tell you one, like at the school, like a lot of colleges, we get grant money. There are grant money. Here's some grant money and you need to spend this on, IT hardware. So it's a grant, but we can only spend it based on what they say we can spend it on. So sometimes what will happen is they'll give us the money, we'll spend it on the tech hardware, and they'll send in somebody to audit. Let's say, did you spend, let's see the receipts and where you have this hardware, the grant money. So that's a compliance audit. It could be a compliance audit with a contract, make sure that the contract is that both parties are meeting the contract. Could be an audit as far as that, but anything that is meant to comply with it. So, the IRS code is probably the most obvious. And if you get audited by the IRS, all it means is they're going to check to see if you are doing it according to the IRS tax code. It does not necessarily mean anything bad. I had a friend who had an IRS audit, and he ended up getting something like $1,200 back or something like that. But he had overpaid his taxes, so it really isn't necessarily a bad thing. It's just they're just saying if you comply with it. Okay, so compliance audits. Now the fourth one is a little bit of an odd one. Integrated audits. And this comes about because of, how do I say this? Okay, issues of financial statements. So this is like companies that are publicly traded. They publicly traded. They actually have to have two audits, one of the financial statements and one of the internal controls. And they have to do those together. It's a requirement that if you do the audit of internal controls, you have to also do the financial audit. So, and this is only for public trade companies. If it's a public trade company, they have to have an audit of the financial statements and an audit of their internal control. It can be two separate reports. They can actually combine them. But more and more you see them as two separate reports. But the trick of the matter is if you do an audit of internal control, you have to also do the financial audit. And the reason for that is financial audit might highlight problems with internal control. For instance, if you find the financial statements are misstated, that could be an indication of a problem with internal control, and so that would go into the internal control report. So, do an audit of internal control, you have to do a financial audit. It does not actually go the other way around. You can actually do just a financial audit of a publicly traded company. I doubt they would do that because the audit of internal control, which they're required to have, also requires an audit of financial statement. But I guess it could happen because you have two audits, two financial. Okay. The Happy Bakery wants to improve production. Which of the following audits would be appropriate for this task?
Operational?
Operational audit, they're trying to improve, so you're gonna go in there and try to help them make, improve their production, how it is. By the way, this is, we would call this consulting, I'm sorry, here, we call this consulting at we talk about for CPA firms. So say, we wanna make our business better, and you say, okay, consulting will give you an operational audit. Oh. City of Chicago needs assurance that grant money for homeless residents is being spent properly. Which the following audit to be appropriate.
That compliance?
Yep. Black grant. Exactly. Okay. Types of auditors. First one would be external auditors. Hey, auditors. Yeah, these would be CPAs. And that's kind of what we're going to focus on. And they're external, they need to be independent. And this need for independence means that they cannot be, you can't be a CPA and be an advocate for the client. You know, so for instance, if we're auditing IBM, we can't go around saying IBM's great, or they're so good, they're this terrific company, IBM. You can't. Generally speaking, there's a lot of things you can't do, especially publicly traded, for the client, because you have to keep that independence. And it's a wacky kind of profession that's different than most professions. You have someone who's a professional, you know, like a doctor. Can a doctor treat his own kid? Yeah, of course. Can a person say a lawyer? You know, a lawyer do legal work for his brother. Yeah. You know, there's nothing wrong with it. When you get into auditing, there is a problem. Can I audit my child's business? My daughter has this photography business and really going on. Anyway, she wants me to do that. She needs an audit, something we got. You're not independent. Yeah, I do an audit of my brother's financial statements for not independent. So it's kind of a strange profession, and then you need to be independent because you get credibility. You're getting credibility through financial statements. So it is strange, but it's one of the really unique things about our profession is that you have to be independent from your client. It's a disservice if you're not independent. Okay, second one, internal auditors. And these will work exclusively for the company or the client. This is actually what I was. So internal auditors are auditors inside the company. So for example, Hey. Internal auditors are people that work in the company, that work exclusively for the company. In this case, our client. So if we had IBM as a client, they'll have a staff of internal auditors. I was an internal auditor for, I think, sorry, but Navistar and US Steel. I worked exclusively for those companies. So we did all kinds of audits. Well, a lot of operational audits, but also compliance audits, and we also did audits, financial statements. So the operational audits were by far the most involved, but we did the other ones too. Now, I can tell you to think about this for a minute. So I'm working for, let's say Navistar. Working for Navistar. I go into Navistar every day to do audit. The external auditors come into Navistar maybe 5 weeks out of the year, 6 weeks out of the year. Maybe a few times more, but anyway, the internal auditors will have much more information, much more in-depth knowledge than the external auditors. We were just there all the time. We were there the whole year. Now, you may say, well, why don't we have the internal auditors do the audit report? They obviously know the company a lot better than the external auditors, right? And we did. Not because we're smarter, just because we were there. So why don't we have the internal auditors do the financial report? Why don't we just take the people that IBM has, and say, okay, do the audit of IBM financial statements. You guys know better than anybody, you know about auditing and all that, so why don't you do that?
High risk.
I'm sorry?
High risk for fraud.
Could be, a lot of these larger companies will have IRS come in, and there will be people. Larger companies every year that it could be, and sometimes I never worked with that, so they probably won't tax it, but definitely could be. The big problem is we're not independent. IBM is signing our paychecks, right? So we're not independent, even though we might know more than the outside auditors, external auditors. We're not independent, and our credibility is nil because we're extremely biased with our employer. So even though we have more knowledge than the external auditors, just because we were there more does not mean that we should be doing the audit. We're not independent. Independence is the key. It's the key to for credibility. It has to be somebody outside. So internal and external auditors there's really different groups and they have different roles. But the problem with them doing financial statement auditing is they're not independent. Okay, 3. Let's say IRS. But those are prevalent. And what they will do is they will take someone's tax return, obviously, and check to see if they are, complying with the tax code. This be a compliance audit. Tax code. Okay, and then we have governmental audit. Oftentimes called the GAO, General Accounting Office. And these are usually auditors that do the government, federal government program. These are good jobs, by the way. GAO jobs, government auditors. Now, the GAO people have their own set of rules. The governmental auditors, they have their own set of rules because there's only one government. You know, we talk about generally accepted auditing standards, generally accepted accounting principles. Generally accepted means all groups do it, right? Government's different. There's only one Pentagon. It isn't like there's gonna be a bunch of Pentagons that are gonna use these generally accepted Pentagon accounting rules. There's only one. So they'll have their own rules to, when it comes to military spending. So there's only one group that buys F-15 jets. I don't know what a jet right now. I think F-35. But anyway, they you know, there's only one of them. So they don't really have the general standards that we have that apply to all companies. Apply to IBM, that apply to Walmart, that apply to Target or whatever. They don't have that because there's only one. So they have their own specific, and it's a weird one, you know. So you know, they don't have all these different companies. They don't need generally accepted rules because there's only one. It isn't set by one group. Okay, but they will check, and I should also say they will actually sometimes seep into other companies to a regular audit because, for instance, let's take IBM. Maybe IBM has defense contracts. I imagine they do. I don't know. But if they have defense contracts, they may have government auditors come in and audit those contracts. So it isn't that, you know, someone like IBM would never have a run, you know, would never have any contact with the government audit. They very well could, because if they're doing contracts with military or with social services or whatever, they could be audited and have a program audited. For companies that do business with the government, there is a few more hoops to jump through. Moving on. Okay. Okay, let's see. All right. ACCT. American Institute of Certified Public Health. Okay, the ACCT is a club that has licensed CPAs as members. You pass the CPA exam, they'll send you a they'll mail you a email. In the past, they would send you a letter that would say, "Hey, we see that you passed the licensing exam for a licensed CPA. Do you want to join our club?" But that's really all it is. So the AICPA is just a club. Okay, so the AICPA, can they take away your CPA license? In this club, like Boy Scouts or Girl Scouts, because the Boy Scouts or Girl Scouts come and take your CPA license. Well, they have no direct power over any. They don't issue CPA licenses. States, they cannot revoke your license. They cannot suspend your license or anything like that. They really don't have any direct control over any. So the ACCT is really just a club. Again, you pass the CPA exam, you get your license, they send you a thing saying, hey, you want to join our club. Okay, and you can say yes or no, you don't have to do. But yeah, so that's what the ACCT is. Now, what do they do? They make accounting standards, yeah. Now you may be wondering, oh, who cares? This club made accounting standards. We can ignore those because it's a club. The SEC says the companies must follow. Securities and Exchange. I talked about that. Requires publicly traded companies and again, let's use the CPA exam terminology. Issuers use accepted accounting principles. Okay, that would be in the same. So they make accounting standards. The Securities and Exchange Commission, SEC, requires publicly traded companies, issuers in our CPA suite to accept their accounting principles. So notice how odd that is. There's this club that makes accounting books. Big deal. They went to make backwards. But the Securities and Exchange Commission says the company, look, there's this group, the AICPA, and you must use their accounting standards. So even though the AICPA can't make companies use their rules, the Securities and Exchange Commission can. Now, it's only for issuers. So IBM must use the AICPA's unaccepted accounting principles. Publicly traded. Joe's hot dog stand is not publicly traded. They can use whatever accounting rules they want. They do not have to follow them. Not publicly traded. The SEC has no control over companies that are not publicly traded. So mom and pop restaurant might be a corporation that is privately held. They don't sell their stock or anything like that. The SEC is completely powerless against them. They're very powerful when it comes to publicly traded companies. They are powerless for non-publicly traded companies. So, there's that difference there. So, and again, when you think about small companies, they generally don't have to use GAAP. it's probably encouraged, it's the best, you know, best set of rules around, but they can use other methods. So only if it's publicly traded do they have to use this. Okay. They also make auditing standards. Oh, gas. Let me accept auditing standards. Let me clean this up. Oops. Now, they don't require public trade companies, they require CPA firms. Auditing standards. The Securities and Exchange Commission requires CPA firms to use the audit, I should say when they audit issue. That's such a. Securities and Exchange Commission requires CPA firms when they audit issuers to use generally accepted auditing standards. So again, the AICPA does not enforce any of this. They can't, they're a club. But the Securities and Exchange Commission says, look, there's auditing standards by the AICPA, you must follow them. The government also has their own standards. You have to follow those also. So you actually have two sets of standards that you will need to follow if you're auditing a publicly traded company. But anyway, the auditing standards are required for companies, but it's because the SEC doesn't have. So the SEC is the one that is really the enforcer behind the auditing standards and behind the accounting standards. And again, these are made by a club. Okay. One other thing that the CPA does is they make the CPA exam. Every state CPA's CPA exam license. Okay, so they make the CPA exam. So the AICPA makes the CPA exam. And every state uses it. Now, they don't have to use it, but they do. So the CPA exam is made by the AICPA. The AICPA doesn't license anything. But the AICPA makes the CPA exam. Every single state uses their CPA exam. Said, oh, by the way, if you want to be licensed CPA in our state, you got to go take the exam made by this club, the AICPA. AICPA club makes the CPA exam. You have to go do it. They'll grade it, send us the grades, and we'll use that as part of our license. So the AICPA makes the CPA exam by the state. And again, states, states can, you could wake up tomorrow and say, oh, we're not using the AICPA exam, we're using our own, somebody else's or whatever. They're licensing for it, you can use whatever licensing thing they want, but every state uses it. It's probably not going to change. Seriously doubt it's going to change. Question on that? Yeah, we're gonna look at that. I want to see something. Jump in. Do me a favor. We're gonna need this for our case that we're gonna do with stuff then. Jump to, is it page 8? Does the page 8 have an E? What page is this on? E, types of audit reports. It's in chapter 2. Is it on page, you guys have it on page 8 or page 9?
It's like half on page 8 and half on page 9.
Okay, yeah, you can do space into, types of audits, reports. Okay, so we're gonna use this, I wanna jump ahead to this because this is for the Medtrans case. Okay, types of audit reports. The first one is called unmodified. So sometimes known as a clean report. The standard report, or the unqualified report. The unmodified report. Okay. The unmodified report is the good reports, what everyone wants to get, and most people do get. The clean report, it states that the financial statements are fairly presented. And that they are reasonably assured that they are free of material misstatements. They may have misstatements, but they're free of material misstatements. The unqualified report is used by the is a terminology. Actually, we used to use it for all of it, but unqualified is for the issuers for Securities Exchange Commission reports. It's all unqualified. If you're wondering why it sounds like kind of a strange term, unqualified usually seems bad. That person's unqualified for the job. It's a bad thing. But what they're actually saying is that there are no qualifications on the report. And a qualification would be like, well, the company, everything on the company's fairly presented, except for, we'll give you this in a second, they'll say something bad. That would be a qualification. So a qualification is something that would put in there to say, okay, here is an exception. If I say it's the weather is sunny in Chicago. Except for some days it rains. Yeah, that's a qualification. So when you go to Chicago, you can't depend on it being sunny all the time because the except for the qualification is sometimes it rains. So an except for is when there's we're going to get to next. So the first one is an unmodified report. The rest of these are what we call modified. Rather than doing on each one, I think I'll just put a heading here. So the next three reports are going to be modified. And the first one is a qualified. And it's often called an except for. Because like I said, they'll say everything is okay except for, and then they can spell that. And it is when there is a material misstatement that is not pervasive. Usually it means that there's, for instance, there's only one account. And it also says that overall, financial statements are fairly presented. Material misstatement, not pervasive. Doesn't go throughout the financial statements. Usually only one account, maybe two. But overall, our financial statements are fairly presented. Okay, so for instance, let's say you're doing an audit and the client has some inventory. And the inventory is being stored in a warehouse. The warehouse is, their employees are on strike. And you can't get in to verify the inventory. No one working there, the place is shut down for now. They have a strike going on, and you can't go in there and verify the inventory. Okay, so what do? You can give them a qualified report saying, look, everything's okay, and then say, except for there's this inventory, this material that we can't verify in this warehouse. Everything else in the financial statements we're okay with, but this inventory we cannot verify. So that's what a qualified report is. And it's when something is material, but it is not pervasive. It's usually isolated to one account, maybe two accounts, but the rest of the financial statements. Okay, so the inventory might be, wow, we couldn't verify material part, but cash is fine, accounts receivable is fine, property, plant, and equipment is fine, liabilities are fine, all the rest is okay, but you can't verify it. Okay, so that is a qualified report. Question yet? Okay. I'm just trying to blank on this. Adverse. I'm sorry. Adverse report. This is when the financial statements are not fairly presented. Not reliable. Material misstatement. And it is pervasive. Finance. You need the R in that, right? Oh, you are in the right spot. Pervasive, and the financial statements are not GAAP. And this is the worst report. This is when the financial statements are, you can't buy. That's not how you spell GAAP. That's how you spell GAAP. And you tell people, look, do not rely on these numbers. They're not correlated to the company's finances. They are not fairly presented. Disclaimer of an opinion, often just referred to as a disclaimer. Disclaimer of opinion. The auditor not get enough evidence. Oops. Form an opinion. So this current opinion is auditors cannot get enough evidence for an opinion. No opinion is stated. And it's a report that simply says we can't get enough information. Okay, now there's one other thing I should have put in here for these, and I'm putting it now. Qualified report and a adverse report all have the unknown misstatement in them. We'll find the misstatements. We could have more than one. So at least they have known misstatements. This one has an unknown. Statement, if any. So a disclaimer is a little bit different, and then it is possible financial statements are fairly presented. But we don't know. We don't know the number. And it might be that they aren't misstated at all, but we can't get enough information. So again, so qualified, we know the misstatement. It's usually isolated to one account. Adverse is the worst. It's a known amount that it's off by or amounts. And you can actually, you'll put it right in the report what the misstatement is. By the way, I'll come back to you later and talk about what happens if you run into finding something. So, qualified and adverse opinion given over. Disclaimer is when you can't get enough. You go to a client and they say, all of their accounting equipment, their computers were all stolen. In effect, and the computers were all stolen. Okay, well, give backups of backup tapes for the backup hard drive or whatever for the. Oh yeah, where's that? Well, it's in the safe. By the way, they took the safe too, so we don't have the backups either. They have no information. There's nothing to audit. So that's what you're gonna come with a disclaimer. A disclaimer just simply says we can't get enough information. We don't know. We don't know what the mistake is. If there is a mistake, there might not be any mistake. So there's a little bit of difference in it. Now, the modified reports, especially like the qualified and adverse, are very rare. And they're very rare for the reason that the known amounts are put into the audit report. So tell somebody, look, your books are misstated by $53 million. You have to correct those, or else you get this adverse opinion. As auditors, we can't correct the financial statements. The client must correct them. To be unbiased, we can't be putting out financial statements for the client. So, we tell them, look, restate this. And if they don't, it's going to go in the audit report and say, let's say an adverse opinion. And the dollar amounts that we're talking about are going to be right in there. So it isn't like they're going to be able to hide, those dollars. So they're going to be right in the report. So say, okay, well, it's going to be in the report. And by the way, when people read the report, they're going to think you're trying to commit a fraud here by putting out these financial statements that aren't fairly presented. So there really isn't there's a big incentive for a client to change the financial statements if the auditor says, even if they don't agree with it, they generally will change it. Adverse or qualified opinions are pretty rare, especially adverse opinions, because they really don't do any good. It's going to be in the report anyways. It's like no one's going to know about this. They are going to know about it. It's going to be important. So they're very rare. Now, do they happen sometimes? Yeah. You have people pounding on tables. You can't tell me to do this. Yeah. So stupid things happen in business. But logically, they shouldn't happen because it's going to be investigated with the state amounts going to be in the report. Takes me down the second. Okay. Oh. Anyway, let's. Let's go through these. 8. The auditors were unable to verify significant investments made by their client. Which audit report would be appropriate for this one? Actually, there's probably a couple that could be in there. Well, which one is probably the one that you would most likely?
Qualified report? No.
A qualified, it could be. It could be a qualified report because it is one account. There's one more that it could be. When you're unable to verify something.
A disclaimer of opinion.
Yeah. And again, the qualified report would be put out and assuming that it, you know, you make the assumption, you put right in the report, look, we can't verify this significant investment of however many dollars, whatever. And the idea would be that even if that was a problem, that it could be the financial statements are still fairly present. Coming back up here, of the modified reports, the one that's the best one to get is this one. So if they can't verify the investments, they say, okay, you know, except for these investments, it could not be verified. Everything's okay. Notice that's better than a disclaimer. Because it's, you know, the qualified report will say, okay, yeah, these investments, we can't verify these investments. Everything else in here is okay. So that actually is a help to the client and for what they paid for the audit, saying, look, you know, we can't verify these investments. However, the rest of the stuff all looks fine. Whereas a disclaimer just says, I don't know. Disclaimer is very unhelpful. A disclaimer is basically you're giving the client nothing. Here's nothing, and here's my bill. Okay. 9. The auditor determined that cash, inventory, and revenues were materially misstated. Which quote would be appropriate in this scenario?
Adverse?
Yep. Very good. Yeah, it's more than one account, you know, it's multiple accounts are all misstated. So it goes through the financial statements, you know, cash and inventory on the balance sheet, the revenues are misstated, that's an income statement. So don't rely on it. Then the other during cash inventory revenues were immaterially misstated.
The qualified report.
Probably not. Qualified report is for material mistakes.
Oh, unmodified.
Yep. Very good. Yeah, and it's not uncommon to have, I should say it's common to have financial, they're always, you know, they're off by an immaterial amount. I found an error of like $100,000 at one of the, I was working with the external auditors, and there was a classification error of $100,000. I took it to the senior, because we were dealing in hundreds of millions of dollars, $100,000 error was not material. So those two accounts were off by $100,000, but it really wasn't material. So it isn't that we're saying that the financial statements are 100% accurate down to the penny. They're not. And that's not, you know, a reasonable person. The auditors were unable to verify a material amount of off-site inventory on a client's books. None of the other accounts were materially misstated. Which audit report would be appropriate to submit?
Would that be qualified report?
Would be, yep. And again, it's material. Not by material amount, but it's only for inventory, it's for one account. And none of the other accounts were materially misstated. Modified report. So why are qualified adverse opinions rare? Here's your point. Maybe you're sleeping. You're trying with me that's bad. You're sleeping, then it's my fault. They include the misstatements in the reports. So if they're not gonna do it, they're not gonna do any good to the client. Do not change their financial statements to avoid it getting a qualified for a person. Okay. I think what we'll do next is the Medtrans case. Yeah, let's take a break though. And let's say be back at what? What that is. Yeah, 7:20. And we'll start it on the Medtrans. Okay. The Medtrans case is a very famous case. Medtrans gave an investor another financial statement showing profits of $1.9 million. The CPA firm comes in, they say they actually lost. $500,000. The CFO resigned. Indicating he could not sign a management letter. Okay, we haven't talked about that. A management letter is the letter that they sign at the end of an audit, at the very end of an audit. At the very end of the audit, they sign a letter and it says, you know, to the best of our knowledge, everything here is correct. Everything we told you is honest and correct, or whatever. So the CFO says, I can't sign that. That's a huge problem. Because it's basically someone saying these financial statements aren't materially misstated, or else they would sign. So because the financial statements are misstated, and the CFO says, I'm not signing. And the firm discussed options, resolving it. And they kind of checked them all. And CEO, well, huffy about it. The firm withdrew from the engagement. Okay, now this is something that's not obvious as what the problem is. Medtrans retained two other CPA firms, both history their discharge was through. The third process, so this is their fourth set of auditors. The fourth auditors came in and they gave a report after they made the adjustments that delayed the key check report. Okay, now you look at this and say, oh, this is pretty cut and dry, and there's no problem there. The problem is with the CPA firm withdrawing from the engagement. We're professionals. And as a professional, you are duty bound to do what's best for your client. For instance, you go to the doctor's office, the doctor is there to do, everything that they can to help you. So, even if you're a rotten patient and they don't like you or whatever, they are duty bound to offer you their services. So, they're duty bound to give you those. So, kind of like, let's say you went for an operation. And the doctor thought it was going to be a simple operation. They cut you open and they find, oh man, that's way worse than I thought. Can the doctor just run out of the room? Oh, I didn't expect that, and take off. No, they're duty bound. They go through the operation to see what they can do what they can do. It'll be future operations, but they don't just abandon you on the operating table. They try to work it out. Same thing with us. Even if the client is a complete jerk, you can't just leave them. And that's what they came up against. So the professional standards are, the established law as being a professional, that you can't leave your client in a worse position than they came to. And Medtrans won trial of these conditions. And they were awarded $10 million. First responsibility was that the CPA could not, under any circumstances, withdraw from the engagement if it unduly jeopardized the interest of the client. Okay. Now, this is the interesting part of this. On appeals, it was reversed. Holding that judges should instruct juries about ACCT standards, which authorizes withdrawal from an audit engagement based on good cause. Okay, so here's the problem with the ACCT rules. So the ACCT says, look, this is a person of ill repute. Withdraw from the engagement. You don't want to be linked up with this person in back in this company. Okay, so that's the the ACCT rules. But you go into court and it's like, oh, this club that I belong to says that I should withdraw. It's like saying, Girl Scouts or Boy Scouts or whatever told me I had to withdraw. It doesn't hold any. Before this case, it went. After this case, and it's been applied to other professions too, says, okay, there are these established law, but they also have to talk about professional standards too. The juries are also that they must comply with these professional standards to keep their licensing and everything else. So that they can use these standards. And again, it's a big step because this is not a government agency. This is a club, basically. And so, but they said, look, so this case has been cited by many different, and again, even groups that aren't in the county. Okay. And the decision of the matter that it can be based on professional standards rather than rules of law. Withheld the auditors upright. Okay, so in your own words, you can just write what the most important part of it is here. But I want to talk about the second one here. So what was the main part of it? The main part of it was that the ACCT standards could be used as a defense if they withdraw from engagement. A more thought-provoking one is what course of action could a delayed teacher have taken to avoid the lawsuit with Medtrans? There's the old saying that once a lawsuit is filed, you've lost because now you gotta defend yourself, get lawyers, all that kind of stuff. So what could the delayed teacher have done to avoid a lawsuit with Medtrans? I'll give you a hint. It's over here. Here we go. Types of audit report. What could they have done rather than withdrawing from engagement? Anyone?
They could have issued them maybe an adverse report or a disclaimer report.
Absolutely. Now, it would have to be an adverse report. I'll tell you why in a second. We can put this into a second top line. They are required to give an audit report. So they could just give an audit report that is an adverse audit. So this would have probably been the smarter way to go. Now, they did win the case, but again, I'm sure they lost a little money out of it. And so, yeah, unfortunately, so it is, that's why these reports are there. So you have this client that says, you better do this. I'm not doing that. You're gonna do blah, blah, blah. give them an adverse opinion, hand it to them, you've now fulfilled your responsibility to the client, giving them an audit report like you were required to. And, give them an adverse opinion. Now, you know by that CEO, he's probably gonna hit the roof and might get sued anyways, but, that would be the way to get out of, say, the liability for professional established law. It says you cannot withdraw. But it's a big thing to withdraw from a client, and I'll bring up one more point about it. Why you say, well, big deal they withdrew and they got somebody else to come in. There is a problem with doing an audit for things like inventory. If you're there to audit their inventory at year end, December 31st, let's say, and then, yes, hold on. Sorry, I didn't get the mute quick enough. If, no, my sneeze wiped out what I was thinking. Oh, darn it. Okay, guys, what was I talking about? Oh, yeah, no, I completely forgot. So yeah, fulfill your responsibility for the, nine man. Stupid sneeze. All right, well, if I think about it, I'll bring it up. Okay, let's go to the, back to the, we'll stop here. Oh, by the way, the Medtrans case you can turn in. Yeah, and so down here, this narrow word be something along the lines of okay, something along the lines of auditing standards maybe there's a fence problem. Okay. All right, let's go to the. Okay, so how are you guys, with, doing problem number 2? Is that okay? You guys okay with that one? Comment? Because here's what I was thinking of, we could chuck through these in class, or I can just let you guys work on them. You guys probably do them as fast or faster than I can. And we'll put up the answers next week, but I think I'm gonna have you do the rest of this as homework. Are there any questions on problem 2? Okay, problem 3, and especially, problems 4 and 5 are similar to what you'll see on the CPA exam. So those are similar to what the problems you see on the CPA exam. Those actual problems are actually on the CPAs. And I think I told you the author of this book, is also the one that does the, excuse me, the Wiley CPA review. And these are, exam questions that were on the CPA exam. I don't know if I told you this or not. The CPA exam used to be an open exam. And, the way it worked was you'd go to, take the exam and something. And, they'd hand you 2 things. They'd hand you the exam that would have all the questions on it, and they'd hand you an answer sheet. And so when you're done with the exam, you'd hand them the answer sheet. And the exam itself, you hand it to them, they put it in an envelope, and give them an envelope, a self-addressed envelope. And so when you got home, they would have the answer key, the answer that she could send them, but the actual exams that you used, they would mail them. You'd have all the questions that were on it. You could look at it and see how you did. So it was what they called an open exam. All the CPA exam questions were open. You knew what they were. After they gave the exam, everyone got it. Now, when after 1996, they stopped doing it. Became a closing. But for things like statistics, these statistics haven't changed in 100 years. So you will have good CPA questions that are exactly like on the CPA exam, or actual CPA exam questions, in kind of the format you're going to see. So these, it's not uncommon to have things like statistics that's been around for a decade, century, that you'll have those. Okay, so I'll let you guys work on it. If you have any questions, you can do next week. But what I want to do is kind of go over this, and we've already talked about this a little bit. Which method is the best method used for sampling? And it depends. Mean per unit is used appropriate when. Items in the sample. Kind of similar to output. In other words, they're all similar amounts. Okay, so we produce when they have similar amounts. So if you have something that has a similar amount to it, it's a good method to use. I think I have used this one before. I'm not positive yet. I've definitely used the ratio estimation. Ratio estimation is appropriate when errors occur in a ratio of book value. In other words, So large item has large items, small items have small items. And this one, I think, is, again, if someone has a $50 account, it's probably not gonna be misstated by $50,000. You don't have a $50 account, it's misstated by $50,000. Yeah, probably occurs, but very, very rarely. It's much more common to have a $50 million account be off by $50,000. That's not that. So there's a ratio. Large items will be off by larger amounts, smaller items off by smaller. $50 account will probably be off by 5, 10, something like that, a small amount. Larger accounts, they tend to be off by a larger amount. Because, any error that's made in them is made at a larger scale. And this is one I use quite a bit. Ratio estimation. One I never used is this one. Difference estimation is appropriate when likely off by the same amount. So large items. Pairs. Small items. $100. So difference estimation is good when every account might be stated by the same amount. And while I never had any sampling that really had that, it is possible for things like shipping and handling charges and that sort of thing. That if it's common to have the shipping charges misstated, or handling charges like $20 or whatever misstated, that if you do find an error, it's probably going to be for that amount. Like I say, I never had that, but it certainly could occur. So mean per unit is when everything's about the same value, the price is the same. For instance, a company manufacturing mufflers. Mufflers that are all kind of made out of the same material. They all, muffler for this car costs $60, muffler for this car costs $58, muffler for that car costs $62, whatever. That is a good time to use the mean per unit. And I think I did use it. I used it sometimes when I was doing inventory of parts for the warehouse. But regardless, all those things have some amounts. Ratio 1 is probably the most realistic as far as the real world, I think, and that is large things tend to be out by larger dollar amounts than small. Yeah, just because of the size of the items that you're looking at. And then the difference estimation one is that the differences will be the same regardless of the size. Okay, so I think I'm going to assign, well, here, do you want to get a picture of that? Screenshot of it. Okay, I'm going to assign 4, 5, and 6. No, 3, 4. What am I saying? 3, 4. And 6 we just did, but put it in there. And that'll be your job for next week. And if you have any questions on it, and next week I'll put it up on screen so you can kind of see if you did it right, but, yeah. So, and you can go ahead and turn that in too. I think some of you have already made it, but, homework problem is 3, 4, 5, 6. And we'll have that assigned for next week. And we're still gonna be working on chapters 1 and 2. I might make an effort to get the chapters 1 and 2 done next week. In fact, I'm going to tell you guys, well, I'm gonna try to get that one done. We'll get it done next week. Okay, so the handout, and again, for the classical sampling, if you want to wait and make sure that you did it right and see what we have next week before you turn it in, that's fine too. So turn that in, and then the Medtrans case, you can submit that. Any questions? I'll be a little quiet in case you are asleep.
Professor, so we have in total 3 assignments to turn into Blackboard?
The assignments that we turned in so far, yeah, will be 3. You'll have the fast fund footwear, which we did last week. We have the Medtrans case we did this week, and if you want to, you can turn in the sampling one. If you want to turn it now, you can turn it in, and if you go through it, you change your you say, okay, I did this one wrong, I want to resubmit it. You can always resubmit homework. Exams you can only submit once, but homework you can submit many times. And I always take that. Quite honestly, if you submit it 3 times, I'm going to go to the third one because I'm going to assume that's the one that's correct. Look at it. But yeah, so you can turn it in, and don't worry about oh, gee, I turned it in and it's wrong, I can't do anything about it. Yeah, you can just turn it in again. All of the homework turn in stuff has a can't see that. Sorry. All of them have unlimited turning. So you can if you submit something here, however you submit it, upload the files or whatever it is. You can do it as many times as you want. The only one you can't do that with is exams. But yeah, so if you go through and you finish up the classical sampling handout, you think you get it. Okay, I think this is right, turn it in. And even if it isn't right, you can always go back and resubmit it with all things. And one thing.
Okay, thank you.
Yeah, I'll say one more thing. One thing too, on the homework, I'm a little more lenient on the answers on them, just so you know. So if it's a rounding error or something like that, don't worry about it. Or even if you did a math error, I usually give 100%. Unless it's something that, if the method is incorrect, then I'll take off points. But if the method's right and it's simply a math error or something like that, I give 100%. On a test, I do take off 1 point for math errors, but I don't do that. Okay. Yeah. So
Okay, great.
Cases, and then yeah, if you want to turn it in, you can. And if don't worry about it. If you turn it in, you can't turn it again. You can, as long as it's not an exam, you can turn it in. So, okay, that's probably enough. All right, I'll see you guys next week. Well, I want to say one more thing. By the way, if you ever do want tutoring or want to go over something, contact me. I know I have office hours on Zoom on Friday at 5 if you want to do that time. But if that time isn't convenient, you can do other times too. I'm fairly flexible. Okay. Enjoy the rest of your evening.
Thank you.
Have a good night.
Have a good one.
Yeah.